This podcast is sponsored by Engineered Tax Services, a subsidiary of Engineered Advisory, whose goal is to support CPAs and their clients to achieve the highest and best use of time and resources. ETS offers specialty tax services and incentives, which help expand your capabilities and ensure that your clients are paying only what is required in taxes and nothing more. To learn more about Engineered Tax Services, go to engineeredtaxservices.com and mention the Healthy, Wealthy, and Wise podcast to receive project discounts and a free CPA partnership ebook. Hi, everyone. This is Heidi Henderson, and you are listening to the Healthy, Wealthy, and Wise podcast for accountants. I am really passionate about people and the industry. And I truly believe that the accounting industry can do better for both our clients and its professionals. So I'm going to share insights from people who have found professional success and who have managed to balance that with their physical, mental, and personal health. So I hope you enjoy, and I hope you get inspired. Accountants can earn free CPE from listening to this episode. Just visit earmarkcpe.com, download the app, take a short quiz, and get your CPE certificate. And now, on to the episode. Hi, everyone, and welcome to the podcast. We have an awesome guest today. I'm very excited. We're going to be talking with Nick Burgess, who is a principal with the Burgess Group. He's been there since 2005. And one thing I love about the company is that it is a family-run company. So hopefully he'll share a few more details about how they've started and how they function as a family unit, because I'm sure that's got interesting aspects of it in and of itself. And since I also work with my sister, I understand some of those complexities that we deal with working with families. So hopefully we get to hear about that with Nick. The Burgess Group focuses on, Nick specifically focuses on regional and national strategic alliances, but really they are providing really sophisticated insurance solutions. And what they do is really unique. When we talk about insurance, this is not, what I would say is insurance sales or life insurance from a typical standpoint. And we'll be excited to have Nick explain more and really talk about the differences in what his team is doing, what they specialize in. But I met Nick because he's part of one of our associations that collaborates with us as a partner in our consulting side with ultra high net worth or high net worth individuals with strategies that can help really increase their net worth and really look at the long-term structuring of their estate planning. And it's a really interesting metric and process they've put in place to help build this for some of these clients and their families. And he works with a lot of CPAs and accounting firms as well as a great resource. I have a lot of trust and faith that I've placed in Nick and his team. And I think how long they've been in business and the clients that they have really shows their level of professionalism and their attention to detail, which I really value in this space. So Nick, thank you so much for joining us today.
Thanks for having me, Heidi.
Perfect. So will you start by give us a little bit of a backstory of the Burgess Group? How did the Burgess Group start? And then how did you sort of fall into line in this industry?
Yeah. Where do I begin on that? Well, you said it. It is a family business, and it really started with my father. He really saw a disconnect between the banking world and the insurance world, and he decided if you could bridge the gap between those two industries, you could make a pretty interesting transaction. He started in the M&A space and then went to the estate planning realm, and that's really where he saw that disconnect. And fast forward to today is really what the Burgess Group is all about, and our mission statement being prosperity with purpose. But you said it really well. We're using life insurance as the vehicle. And, I'll be the first to admit that, as soon as someone hears life insurance, most eyes glaze over because it's life insurance. But
Yeah.
it really is, right? It really is one of the vehicles that we use because of the tax benefits that it creates. And the unique part is we're funding it with banks' money at very low or attractive interest rate costs of that money. And by doing it with the bank's money, we can now, it's a much more efficient way to procure an asset class or a new asset class through the life insurance dollars that comes in, if held properly, estate and income tax free. So from there, my dad was really part of with some of the first beta tests with some of the banks to get this done. And, then he met my mom and they got married and had kids, and we kind of just grew up in it. I remember growing up, I really didn't want anything to do with the business. I mean, I loved going to his office and pretending I was this businessman. I remember those images, but when I started to learn what it was, as far as being life insurance, I remember feeling like, yeah, I don't want any part of this. But I didn't really have an educated reason as to why. I just knew I didn't want to be in the insurance space.
Mm-hmm.
And, from there, I dabbled in a lot of different areas. I think we're all very entrepreneurial at heart. I know that's how my father really started it, off of seeing a disconnect and really building something that from the ground up. At the end of the day, it's leverage. There's nothing new about leverage, but at the time, this strategy was very new. And you can talk to a lot of individuals, from accountants to attorneys, and we work with some of the best in class on both sides, where they're not familiar with this at all. And the
Mm-hmm.
term for it is called, premium finance. It's not a word that I even use, because it paints one picture. It paints one spoke on the wheel, if you will, where you're using a bank's money to fund life insurance. That is one spoke on the wheel, and you can find any bank, any insurance carrier out there that's willing to do this. But when we get into a transaction that's actually going to last, or a healthy, good transaction, right? There's a big difference. And that's one of the biggest pieces for us, is helping individuals, accountants, attorneys, clients identify how we differentiate from other groups out there. Because again, like I said, there's nothing new about leverage. So,
So when was the Burgess Group founded?
let's see, we are in our 31st year now. My father's been in the industry about 45, but he started the Burgess Group about 31 years ago now.
Wow, that's awesome. That's very cool. And it's not just you in the family business, your siblings are involved as well, right?
Correct. Yeah. I'm the oldest of three brothers. I want to say I jumped in first, but my stepsister, who is also part of the family business as well, she kind of led the way on that side. She's older than I, and she started. I dabbled in my other areas and realized, well, I might as well see what this is all about, so I can make an educated decision as to why I don't want to do it. And when I did that, I realized it fits right in line with the entrepreneurial spirit. And it was actually very, very interesting. And so
Hmm.
I dug my heels in and ended up loving it. And each brother kind of went through their own experience in life and naturally came in. I think that's why we've been successful, because it's really something we love and we naturally came into it. So,
That's really cool. Well, I love that it's been 31 years. I love that, each of you guys had your own individual paths. And, I always think it's interesting with siblings, with my siblings, as well as with my kids who are all in their 20s,
Mhm.
to see the differences and how vastly different their personalities are. So for everyone to have sort of arrived at the same location, so to speak, in terms of what they're doing professionally is profound. That's very cool. But
Right.
aside from that, back to a comment you made, is that with a lot of your clients, a lot of the accountants, one of the biggest things is really trying to identify differentiators. And
Yeah.
I think that's a big deal with all of us, with what I do as well, is sometimes you've got things that are commoditized and they become, just simply a transactional service that you can find dime a dozen in certain places. So what is it that makes you, for our listeners, I do want to dive in a little bit deeper into exactly what you're doing. But
Yeah.
before
Yeah.
we do that, what specifically are some of those key differentiators that you've identified?
Yeah. You kind of took the words out of my mouth. The commodity piece is usually where we start. And some of the pitfalls in the premium finance space is that you've got people selling this as a commodity. You've got people selling this as it's free insurance and that there is no risk. And that sounds very attractive, but it couldn't be further from the truth. It's
Hmm.
premium finance. What we do should never be sold as a commodity because it's not for everybody. If everyone could do it, absolutely they would. But it's just not for that. I'll get into what some of those parameters are. And then any transaction that anyone does has risk. So for it to be sold as that there is no risk, I mean, I can't speak for everyone, but anytime I hear something that has no risk, I walk away because that's usually too good to be true. And these transactions, it's leverage. It has risk. But for us, and where we differentiate is we're able to speak. We're not going to run from what the risks are. I think the more clients understand, and not just the clients, but their attorneys, their CPAs understand all the moving pieces and what exactly we can identify what those risks are, the easier the transaction becomes. And
Hmm.
we're really looking for those clients, not only that qualify, but have a need, but that aren't afraid of understanding the risks, because then we can compare those risks to the alternative. And there's not that many alternatives when you're trying to solve an estate tax or add additional income or looking on a corporate planning setting for a key man, buy, sell, golden handcuff type strategy. And then on the philanthropic side as well. It's one area that we do a lot in, but
Hmm.
being able to compare, talk about the risks, what the moving pieces are, and then compare that to the alternative is one area that we really focus on that helps us differentiate.
Okay. Well, yeah, and I want to dive into you just briefly brushed over the topic of the philanthropic side, but early
Mhm.
on you said specifically you call it prosperity with purpose. And I think that's a huge component to what you're doing. To kind of recap, we talk about premium finance, and really we're looking at these incredible, they're not called whole life policies, right? What do you call them?
Right. We're using permanent life insurance
Yeah.
because
Okay.
it needs to have the cash value component, because
Yes.
at the end
Got
of
it.
the day, right, the
Yeah,
cash
yeah, yeah.
value
I couldn't
secures the
remember
loan.
the term, so, yeah, we've got the
Right.
permanent life insurance, which then
Mhm.
you are able to utilize financing a small amount of collateral to essentially then create financing that pays the premiums, because the premiums are pretty significant usually for a lot of these large policies, right? But
Correct.
those payments gain in value because they have a cash value associated with them that's just growing. So
Correct.
it's this whole plan that you were saying has kind of this estate piece, but then moves into sort of this philanthropic side. Can you,
Yeah.
for those of us, listeners, this is a pretty complex topic. I've gone through this with you, I think, 3 times now, and I'm still trying to wrap my head
Right.
around all the ins
Yeah.
and outs of sort of over this overall structure. But
Mhm.
give us kind of the layman's terms,
Yeah.
say we don't understand anything about how this works, but why would someone wanna do this, and what's the end goal?
Mhm. Yeah, no. So let's use a real life example. I think that
Mhm.
usually helps, and I'll just simplify it. We had an accountant refer a client to us that is 56 years old now. He'd actually been paying. He was used to paying for insurance his whole life. He's been paying for term insurance, which does not have a cash value component. That's usually the cheapest form of insurance, right? And it does have a place. I'm not knocking term, but he's been paying for term. He understands life insurance, and he's 56 now. And after working with his attorney and his accountant, they recognized he had about a $15 million estate tax problem that he needed to solve, as his kids were involved in the business, and they were real estate heavy, and he recognized he didn't want to put his kids in a state tax issue or leave them with that. So
Okay. So
he,
I'm gonna ask you a really quick question.
Yeah.
And I apologize for interrupting, but so you've got this 56-year-old with a $15 million estate tax problem. So they've
Mhm.
identified that if he was to pass away right now, that based on his estate, the estate would incur $15 million in tax. Now, I've got some clients to give us a real world example and tell me if this kind of correlates. I have a client in California who there are 3 siblings. They
Mhm.
are working in the family business. The parents were immigrants to the US and ended up buying real estate, and they own these incredible properties around the San Francisco area that they manage and they operate. And
Mhm.
they are wholly owned by the parents that are now in their 80s, and they're
Right.
realizing that when their parents pass away, they're going to incur a step up in basis on the real estate and on all of the assets and incur a massive tax liability that the only way for them to pay the tax will be for them to sell their real estate, which their real estate is up they're operating, memory care facilities. So they actually
Oh, well,
run the business, and each of the
right.
3 kids has one facility they run and manage. So if they have to sell one of those businesses and buildings to pay the tax, they essentially now have cut the ability to have any future revenue because
Right.
they have to sell that just to pay the taxes incurred on the death of their parents. And so this was
Right.
an issue they were trying to solve. So I think that's kind of a real world scenario where, if we're looking at someone with a large estate tax problem that we're prospectively identifying, that this is what you're looking at with this client, right?
Yep. Exactly. And
Okay.
if they don't, to your point on your clients, if they don't find a solution for that, the kids, to your point, are going to have to pay that huge estate tax, and the only assets are they're going to have to fire sell, to
Mhm.
your point, the real estate in and pay that estate tax to the government within 9 months. And having to have a fire sale on real estate and selling those, what it's worth for pennies on the dollar is not something anyone would want to do. And that's where this can come into play, and where now we can, like I mentioned, procure the insurance dollars. This is, I love a client that hates insurance, and that's fine. You can hate insurance, but I can tell you, why not use your most hated asset to pay off, to pay the government?
Yeah.
At the end of the day, if this individual, if we're going back to my client that needs to
Yeah.
solve, $15 million, he's not a fan of insurance. He has paid for it his whole life. And he recognizes that, out of his options to solve the $15 million estate tax problem is he could do one of 3 things. He could do nothing, which would be right, self-insuring. He could go back to the way he's been doing it, which is paying for premiums, or he could finance it. And financing is where we come in, and that's a relatively new approach for him. And so we wanted to walk him through what each one of those options look like, right? Because that way he can make the most educated decision based off of the options that are out there. And then there's not a fourth option that I'm aware of. So if any of your listeners come up with one, please let me know, because that's about all I know.
Yeah.
And so by taking that strategy, we walked him through. He recognized that doing nothing, self-insuring, was not the option he was going to go down. So he's left with paying for insurance or financing. So his options with paying for insurance were term insurance or permanent insurance. And he recognized, since he's had term, that buying term for an estate tax really isn't the best strategy. Yes, it's going to be the cheapest strategy, but what does that really get him? Because when we did the analysis, he recognized, he's 56 now, the longest term he could find in a financially sound carrier was about a 20-year term. And after the 20 years, his outlay was about $1 million to maintain the $15 million of insurance for the next 20 years. But that only got him to age 76.
Mhm.
And his mortality is not 76. It's at that point, it's more, he has longevity, at least 85. And if he has to re-up that term insurance from 76 to 85 or 86, those premiums are going to readjust to his new age and be well over 4, 5, 600,000. So he recognizes that's like renting, not the best option. So we went into the permanent example, and permanent could be whole life, It could be universal life. It could be index universal life. It could be variable. I don't personally think variable is the best option because it brings on all the market risk. If the market falls, so does the product. It doesn't have a floor. So we walked him through that. Now that's a better option because it is building that cash value piece. So at the end of the day, we measured what does it look like in 10 years? He'll have put about 125,000 in a year, and after 10 years, he'll have put in 1.2 million. Well, his cash value was like 850,000. So and plus his death benefits at 15. So his true cost really isn't the 1.2. It's the difference between what he's built up in cash value and what his outlay was. But the beauty of that is that death benefit's actually going to be there when he needs it versus where term will only get him to a certain age. Well, we can take it a step further because now, we're measuring opportunity cost. And the third step is, okay, let's take that same permanent product that we just showed you and let's have the bank take over the premiums, right? So now his outlay, which we could measure opportunity cost from term to permanent, his outlay is now zeroed out. Again, like I just said, I'm not saying that it's free, but we can keep his balance sheet intact. His participation, since he's not going to be paying an after-tax premium dollar cost, will be posting or leveraging an asset as collateral for a number of years. And in this example, we end up procuring the exact same solution that the permanent example was showing him, except for we eliminated his out-of-pocket cost, which is now tapped into and solved the same assets that he needed for the 15 million to cover the estate tax. But again, we've kept his balance sheet intact. And when we're able to walk him through each one of those comparisons and show him where the risk is in each one of those comparisons, it ended up being a no-brainer for him. And this is coming from, like I said, this referral came from his attorney and his accountant. And they walked through every step with us so that they could, help the client, make an educated decision as well. So it's just a much more efficient way to solve what high net worth clients are already doing.
Yeah.
And
Okay.
they
So he's then collateralizing that. So he'll have some collateral that he's posting, but
have.
he's financing the premium, so he's not coming out of pocket on it. What is the end result? So for this gentleman,
Yeah.
you were able to structure this. What is the end result? Let's just say, if you project that his lifespan is to 86, which he's 56, so we're looking 30 years down the road. What is the end result then in comparison to, we now know what would have happened in his term policy scenario, but in what you had him set up with, what do we end up with?
Yeah, when we fund these because it's permanent and because we're using the bank's money, we're going to be funding these at an entirely different level than one would be able to fund it or as with their own money, right? So we're going to be funding these policies so efficiently that they are going to, typically grow through we're solving through an age 120. So we can solidify that this insurance is going to be here. We're not funding it at the, as they call it, target levels, or again, what a normal individual would pay out of pocket. We are supercharging these premiums and funding them at the max non-MEC level. If that strategy works, we can even overfund these as they call a MEC, which that gets into the charitable piece, and we can get into those acronyms in a moment. But the end result is we're going to fund the permanent life insurance using the bank's money. The cash value of the policy is what ends up collateralizing or securing 90+% of the loan. So for an example, if the premium going in is 10 or 5 million, right? If the premium going in from the bank is 5 million, you would typically think, okay, the client then is got to post collateral of 5 million to utilize as collateral for their skin in the game. Well, the beauty of this is that these policies have cash value. So if the premium is 5, the cash value, because of how we're funding this and we're trying to get the policy to reflect as much cash value up front, the cash value of the policy is actually 4.5. So the true collateral for the client is the difference between the loan, which is 5, and the cash value, which is 4.5, which is a sliver, which is 500,000. So this client knows they're going to collateralize an asset, which is going to be about 500,000. Now, what can they use as collateral? They could use cash, stocks, bonds, but like I said, these clients are heavy in real estate. So we have over 14 lenders we work with, and one of the lenders we work with can actually utilize real estate as collateral. Now, so we can go back to these clients saying the actual asset you can leverage is the asset that you have plenty of, which is real estate. And they ended up getting just a standby letter of credit off of a Zillow value, off of the millions of dollars they had sitting there in real estate. And one of our banks simply used that as the outside gap collateral to cover that sliver shortfall after the policy is really what secures 90% of the loan.
Wow.
So at the end of the day, we solve that estate tax. When they pass, they know the gross death benefit is going to pay off the bank. Upon death, the bank will get all their money back. The collateral is released back to the clients, and the beneficiaries, that individual's children that are in the company, will at that point receive a check. Actually, it ends up growing for more than 15. At the end of the day, based off of very conservative assumptions, it grows to about 20, 22 million. And that'll go to their kids, a $22 million check that's 100% income and estate tax free. Again, it's going to be held outside of their estate and held within the trust, which is why it's not included in their estate when they pass. But we solve that need for him, and he leveraged an asset that's just sitting there.
Wow. Yeah, I mean, that's that's pretty tremendous. And to your point, it's life changing. Like in the example I was saying of the family that I work with, I mean, that's a real problem. And sometimes we look at this and think, gosh, this is for people that have I think a net worth of 10 million or more, to where this is really a good structure for someone in that category. And we look at it and think, well, gosh, these people are doing so well and they have a lot of money. But in high tax states like California, where these guys are paying very, very, very high tax rates, it can make or break the difference between the children's ability to continue to function and thrive when it's looking at what they would have to pay out in a death situation. So the tool is pretty tremendous. So let's add in then the secondary aspect of this. I think that case study is amazing with this 56-year-old. But where does the prosperity side come in? Where does the philanthropic side roll into all of this?
Yeah, that's the part that really gets me up in the morning for what we're doing, because that really helps us make some game-changing gifts that, are happening daily with the work we're doing. But that comes into play when we are overfunding these policies as what we would call a financed MEC, and a MEC stands for a modified endowment contract for all the listeners that want to look up insurance acronyms. But that's basically just a 7-pay test rule that was implemented on insurance, that if you overpay premium over the 7-pay test rule, it'll turn these insurance contracts into what is called a modified endowment contract. And if you fund it that way, or turn a contract into that, basically it's changing some of the taxation within insurance, because what happens is you basically, the IRS stepped in and said, people are abusing the way insurance was made, where they're funding it in such a way that it's starting to act like an investment. And that's not what insurance was meant for. So when you turn a policy into a modified endowment contract, you typically lose your tax-free withdrawal ability, which is a huge component of insurance. And if you touch any of the cash value, once it's exceeded the basis, any of that growth will typically be now taxed as ordinary income, right? Now, the death benefit is always tax-free, but it's for individuals that turn their policies into a modified endowment contract, where that growth, when they're pulling that out, if they ever want to pull that out, again, they're going to have to pay taxation on that, on the growth. Now, when we add in the loan component, you're basically changing those rules that make it even more inefficient, if you will, for an individual, as that it creates a phantom tax issue that basically clients are going to have to pay taxes on a dollar that they never used. It's one thing to pay taxes on a dollar you used. It's another to pay taxes on a dollar you never used. Where in the first example, I said, if you touch that cash value, any of the growth is going to be taxed. If you don't touch it, well, then you don't have any taxation. On a financed MEC where you're using the bank loan to pay the premiums, basically you're going to be issued a 1099 whether you touch the cash value or not. So we are creating it. It creates that phantom tax issue for clients, and they're not even if they've decided not to use or touch any of the cash value, that is a problem for any client. Nobody wants to pay taxes on a dollar they didn't use. So the prosperity with purpose comes in where we can basically, we're not changing the MEC rules. We're not messing with any of that. It is what it is, but we're able to basically absorb some of the phantom tax issues by meeting and satisfying the IRS rulings, which ultimately leads to philanthropy. And for our high net worth clients, we're seeing more and more, yes, they're wanting to, they don't want to leave their kids in an estate tax issue or whatnot, but they also don't want to leave them more than what they need. And we're seeing, which is something I really like hearing, as, they're not wanting to ruin them. And so they're, these overfunding transactions and turning them into MECs really, at the end of the day, allows us to solve what the clients need and give a large chunk to charity that these clients are already super passionate about. So it allows us to kill two birds with one stone. And the amount that goes to charity are game-changing gifts. And so that piece is just something that really gets me excited in what we do.
Yeah, that's really interesting. Let me ask you this. What's the difference between just simply paying out charitable gifts versus utilizing a vehicle like this to filter it? And I ask that because coincidentally this morning I saw some news article pop up in my thread that was something to the effect that there's a billionaire family who has paid out $1 million in charity every single week of this year. And they're on 52 payments of $1 million a week to different charities. And, I thought that was kind of fascinating article discussing what they're doing and their ultimate goal of making a difference and providing funding for philanthropic work. But is there a benefit to utilizing one of these vehicles as a source to do that versus what they're doing, or is there no correlation between the two?
No, absolutely a benefit. It's just we work with some of the largest universities, clinics, foundations around the country in helping build endowments or amplifying gifts, donors' gifts, because that's exactly what it does. It's not going to change what donors are already giving. It'll only enhance it. Ends up putting 5, 10, 20x on the back end of what they're already currently giving. And especially for, we've worked with several billionaires where when the light goes off, they're recognizing, they're already going to be giving, what they want away. They've already typically earmarked that, but they're going, wow, based off my net worth, I have another asset class that's just sitting there and it's untapped. And that's what they're worth in the insurance space. Now, a billionaire can't get enough insurance based off of what they're worth because anyone taps out at about, 300 million of insurance. But, for someone that has that net worth, when they recognize, wow, I've got 300 million that I could tap into, and I could tap into it using the bank's money, and I can collateralize any one of the number of assets that they have. Typically what a billionaire can utilize as collateral is, they no longer have an issue of, the meaning of collateral. It's different for when they get at that level. So, but they're recognizing, okay, so I can keep doing what I'm doing. I could also carve out a fraction of my bond portfolio or my real estate portfolio to leverage as collateral for a number of years, tap into all $300 million of insurance that I'm worth, that the insurance space says I'm worth, and I can give and pledge all of that to XYZ charity or, something that they are passionate about. And again, it's going to come in and grow. It's going to grow and come in, I should say, tax free at the end of the day. It's just, a way to supercharge again what they were already doing. And if they don't tap into the insurance dollars, they're going to leave it on the table at the end of the day because, we all die. And
Yeah.
this is, like I said, just a much more efficient way to tap into that.
Interesting. Yeah, it's such an interesting concept. I mean, it's like I was saying earlier, it gets a little complex and it's technical.
Yeah.
And then sometimes it takes a few times to go around to really understand how it all ties, but really is
Yeah.
interesting and applicable, I think, for quite a few people. So tying this
Mhm.
back over then to, I think my audience will likely be mostly accountants and CPAs, and we work with a lot of CPAs that are consulting
Yes.
and really striving to encourage the space to become more advisory and to think more outside the box in terms of solutions for their clients and not just compliance. It's not just about filing a tax return, but our clients are wanting to know that we are thinking and looking out for their best interests in terms of some opportunities that exist to help them strategize. Exactly like the case I was using earlier with the California family and in some of these instances. So with that said, I'm assuming that you have a number of accounting firms or CPA firms who utilize your services or have come to understand this and are able to consult with their clients on this or sort of bring you in. How have you seen that
Yes.
go in this space? I mean, I'm curious as to how receptive you've found some of the accountants to be and how that's worked
Yeah.
for them.
Yeah. Well, I can tell you, I'm sure with this discussion, at the end of the day, no one's going to do what they don't understand. And I'm
Yeah.
sure, with these first discussions, it probably is, like you said, it's a lot. There are a lot of moving pieces. It is complex, but we spend the time, and these are not short-term transactions. This is not something that we do. We don't do 100 of these a year. And that's something that I really like. With the clients we take on, it's a very select few, and we're really making sure they qualify and that they have a need. But with the accountants we're working with, we don't expect when we're talking about this, them to have to now regurgitate any of this back to their clients. Because one mistranslation and obviously it's going nowhere. But what we do know is that all the accountants or the attorneys we work with, but specifically on the accounting side, is we do know that their clients, especially the high net worth, most are going to have in that high net worth status, are going to have an estate tax issue. We know that a lot of the accountants we work with have a lot of corporations, businesses they work with where they're working on key man, buy, sell, golden handcuff type strategies.
Mm,
These are all things that they're very, very much aware of that they're talking to their clients all the time about. Where we come in and we stay in our lane, we're very niche, we're very focused at what we do. We don't dabble in other areas. We can now just come in and show them, here's a much more efficient way to solve the needs that you're dealing with your clients on a day-to-day basis. Because the reality too, with accountants, and I find it funny, is that, and it's why I specifically really like working with accountants, is they are the most trusted advisor.
yeah, absolutely.
Clients look at their accountants as though they can fix anything and everything, which is a problem because, the reality, I think, and I wish it was, the relationships I'm looking for and the ones that really flourish are, the reality is the financial advisor, the attorneys, the accountants, we all have the same client. And we all specialize in different areas. And I wish there was a lot more collaboration for three of us to work together more. I understand there's a lot of bad actors in this space, especially in the insurance space. And so people have been burnt. There's been alternative motives. And anytime there's money flying around, yeah, you have to be, trust has to be there and professionalism has to be there. And you have to be able to, you know, truly come from what's best for the client at that standpoint. But that's even more so a reason why I wish and want to work with individuals that have that open collaboration on our levels, on the financial advisor side, to the accountant side, to the attorney side. The more we can collaborate, the more we can get done and share different ideas to speak to different needs of these clients. And so when we go into these accountants and working with them, yeah, our goal is to show them how we can bring a better solution to what they're already trying to solve for many of their clients. It may take some time to go through how our transaction works, but we'll spend that time. And we've developed a lot of other tools that really simplify that process, which I think I've talked to you a little bit about. But the audit system that we built, that
Mm.
was really designed for the centers of influence we work with, the accountants, so that it can simplify everything we're talking about, eliminates all the complexity, and gets to the heart of what I know 90% of their clients already have, which is life insurance, right? You
Yeah.
you think of one simple discussion I was having yesterday with a large accounting firm that I'm working with is we've done probably over 30 transactions over the last 10 years with their firm. And how it started, and we were just reminiscing about it, was, you know, uh, they said they loved it. They just didn't know how to broach any clients. And
Mm.
and I said, that's where this audit comes in. And we said, how many of your clients are actually, let's not worry about premium finance. How many of your clients are actually just paying for life insurance? He didn't know off the top of his head, but we ended up finding out that it was a large number.
Mm.
And the next question I asked was, okay, how many of those policies do you think are performing the way they were sold? Another question he couldn't answer, but when I started showing some of the statistics, the unfortunate reality is a lot of policies aren't performing the way they were sold. And that's for a number of reasons, which is there's a lot of turnover with insurance advisors in this space. They're typically sold to individuals by their brother, cousin, neighbor, what have you.
Yep.
Um, and it's the insurance space is hard. It's sales,
Mhm.
and there's a lot of turnover. And so the proper reviews of these policies aren't being done. And if someone is not reviewing these permanent life insurance policies on an annual or every 2 to 3 years, if interest rates change, these policies can end up eating themselves up. And some of these clients, may have spent hundreds of thousands, if not millions of dollars of premium and expecting when it was sold to them, these death benefits to be there. If we do an audit, we find out the audit's going to do exactly that. It's just going to go in and do an analysis to make sure these policies are healthy. If this analysis comes back and we have to show the client that, look, not only is this policy not healthy, but it may lapse in 2 or 3 years and you've already put in, you know, $3 or $4 million, that's not a fun conversation to have, but the
Mm.
clients appreciate it because the audit's going to show them what they need to do to save that policy or pivot to something else. But as you can
Mm.
see, we're just talking about now life insurance. I'm speaking to a problem that they have. I can now pivot if they qualify and they have the right net worth and they have a need and we understand what's going on in this situation. We can pivot to the financed insurance solution as another option. And, we dove into that without having to get into all the complexities that we've kind of
Mm.
gone through today. We're speaking
Yeah.
to pain that they're currently feeling.
Yeah, really interesting. Well, and I think those are super key points for accountants because, we look at
Right.
that in advisory mindset. It's about having the arrows in your quiver and continuing to
Right.
add more arrows to the quiver. You don't have to be an expert in everything and you don't have to understand the technical aspects of it. I know that our goal through engineered advisory is to bring in partners who are the best in the business at everything they do and then
Right.
just simply giving our firms the tools to know how to identify opportunities. And I think in this, it's as clear as, net worth of 10 million or more. And then also I love the audit aspect. You're saying, how many of your clients are currently paying for life insurance? That's a pretty clear metric to just look at that from a baseline. maybe a little bit more in depth to say how many of them are performing as they were sold. And maybe it's worth doing an audit to make sure that there's
Mhm.
value and they're not just throwing their money away. And that's another sort of simple segue for a CPA to have that conversation with their client and broach the
Mhm.
topic. And then finally, of course, I think understanding and identifying that they will likely have a large estate tax issue, and being aware of that. I think one of the most difficult things when we deal with a CPA or client who is contacting us about solutions, and they say,
Mhm.
"I had a conversation with my CPA, and I said, 'What can I do?' And the CPA says, 'Well, you just paid the tax. You're doing great. Congratulations.'" And certainly there's a
Right.
time to do that. But there are so many phenomenal tools available in the tax code that are legal, that are part of these incentives available to taxpayers, to be able to deploy and implement some of those things, and the value that that can bring to a client. For a CPA to have that conversation with a client, the potential value is astronomical. Certainly
Yeah.
builds the relationship,
Yeah.
and loyalty that you gain because of the value that comes into play. So I know we have really enjoyed the relationship with you and your firm as well, and certainly trust what you guys are doing. Before we wrap up, because this is the healthy, wealthy, and wise discussion,
Yeah.
I would be remiss if I didn't say, Nick, you are a young, healthy, fit guy. I don't know much about what you like to do on your off time, but I love sharing people's. I don't know if you want to call them tips and tricks, but I am a huge believer that if we just get in the habit of doing something and we allow it to become a habit, it becomes our lifestyle. And if we
Mhm.
choose healthy habits, it can change everything. So for
Mhm.
you, what have you done or what matters to you from that stance to take care of yourself mentally and physically? Because I think the mental and physical aspect in that harmony and balance between work and the stresses of work, we have to look at that in a holistic viewpoint and take care of all of it for us to truly be successful. I'm so passionate about it because I really believe success has to have all of those components. So tell me a little bit about, diving into personal Nick. What's personal about Nick that is driving you to keep that balance?
Okay, now I gotta shift into vulnerable side.
Yep.
Yeah, yeah, no, I mean, I think this is such an interesting topic. I mean, mental health is, obviously, the light has been shined on that bright
Mhm.
over the last, I don't know, 7 years, specifically, especially during COVID. I think mental health really, people are starting to see that that's important, and it's
Mhm.
funny to me. I've my whole life, I've always thought that I've had good mental health. I could speak as though I've done, I could speak as though you might walk away going, wow, he's probably done, he sounds like he's done therapy or he's read books or, I think I painted a good picture, but it's actually what I believed. And it's not
Mm.
until COVID and meeting my spouse that I truly learned what mental health truly was and what
Mhm.
being vulnerable really was. I we've had our ups and downs. I read something this morning. Real love really goes through it, and
Mm.
it doesn't just happen. And that spoke loudly to me because that's really what ours has felt like. I always thought it needed to be perfect, and bumps in the road meant you were falling apart. And through all of that, I really jumped into therapy over the last probably 4 years with my relationship. I recognized that, some of the things that I'd been doing my whole life weren't working. And I had to really analyze why they weren't working. And they weren't working because it was one sided. It was coming just from me and what I wanted. And it basically, I wanted love, but you can't have love without being vulnerable. How can how can you meet that, right? How can someone else meet that if you can't show that? And so she was really helped me find that side and want to find that side, if you will. And I've just learned so much about mental health, and it's actually slowed me down in a good way within the work that I'm doing. I thought, for example, the more I got done throughout the day, it was about items getting done. That just meant the more successful I was, and um, since moving to Seattle over the last year, I've really slowed down, and that's really hard to say for me because I think part of me feels like that means I'm failing in some way. But what's happening is I'm less stressed. I'm actually more productive. I am getting less little items done throughout the day, but I'm happier. And that reflects with the relationships, my clients, the accountants I work with. I mean, my most importantly, myself and my wife. And it just slowing down, accepting, and controlling what I can control, and letting go of the rest has been those three things have been just life changing for me. And I couldn't have done it without therapy. And therapy is always a scary word for me to say. Um,
Well, so so to that point, I think this is so interesting because I'm identifying a common thread through my podcast that I honestly did not expect. And one of my first podcasts with Philip Wentworth, he's a big, college athlete, big guy from Texas. And I asked him a similar question, and his result was, I started going to therapy and it's been life changing. And I
yeah.
literally, my jaw hit the floor. It was the last thing I expected. First off, because I didn't expect it coming from, this big, healthy, strong guy. Same with you,
Yes.
Nick. But secondarily, because there is absolutely a perception about therapy, and guys don't talk about going to therapy. Like, that's such a girl thing to do. Like, is that the
Yeah.
worst? Is that the worst mindset ever? But
Yeah.
I think it's so incredible. And I so appreciate you sharing that because, again, I'm finding it's fascinating in my conversations with people on this podcast to find that I'm finding this common thread thinking, I'm going to hear about all these amazing exercises and things people are doing. And it's actually circling back to it being about therapy and it about being trying to find that mental balance of where we need to be in our minds. And then the fact that you've identified that need to kind of slow down and be okay with that. Because I
Yeah.
was also reading an article the other day that was saying that same thing. We have this mentality that we have to be super busy all the time and we have to be running 100 miles an hour to be successful. But
And
in
if you're not, you're
reality,
lazy.
yeah, you're lazy or you're not productive or you're whatever, you're failing. And you
Mhm.
hit the nail on the head with that comment because I totally agree that there is kind of a perception and we've gotten into this mode. And also what you said about COVID throwing us into this all of a sudden shining a spotlight on our mental health and how much we need people in our lives and the connections. And I think
Mhm.
reevaluating what matters and coming back to that sort of mental health balance. And I mean, I'm inspired by just hearing you share that because I think it's huge.
Well, yeah, and you take that logic that we all have programmed into us and going, okay, I like to work out, I like to bike, I like to ski, I like to go to the gym, I like to eat healthy food, I like to learn about my craft. I so I spend time doing all of that, and by
Mhm.
spending time doing all of that, I get better at it. All I was ever doing with mental health, and I think a lot of people are, is we talk about how our mental health is good, but there's a big difference between talking about how you feel good or that you know what the right thing to do. It's another thing to actually do what you do when you go to the gym or when you bike. You're exercising your mind, and
Yeah.
that I never I used to say that to myself. I used to know that, but I now see the big difference between being able to talk or maybe it's reassuring myself that I'm okay, right? And I think I was okay, but the point is there's a big difference between being able to say I'm working on myself and my mental health, and actually doing stuff to actually make your mental health better. And doing that on a daily basis is a game changer, and something that I've both me and my wife have been doing for the last 2 years. And that's as much of a routine now as eating healthy and working out or anything I do. I'm actually incorporating things that actually make my mental health better. And that only makes me more productive and happier and just who I want to be.
Yeah. I love that. I think you gave me a new hashtag I'm going to start using, exercising my mind. I think that's when we need to start sharing. So, well, Nick, this has been amazing. We are kind of at the end of our show. I don't want to keep you too long, but I love the conversation. I'm fascinated by what you do. I think the service that you offer is tremendous. But aside from that, you and your family are incredible. And I know that you are the best in the business in terms of your professionalism and the care that you take and the due diligence. And I so appreciate that, particularly in this space. So thank you so much for joining me on the show. Love having you. Always love the discussion. If you guys liked the show, please subscribe. And if you liked it, rate us on Apple Podcasts or wherever you listen to podcasts. If you didn't, send me an email, give me feedback. But thanks so much for listening. And Nick, again, thank you for joining. Can't wait to see you again. And I hope you have a great afternoon.
Thanks so much for having me. Thanks.